Hello, everybody. My name is Yaman, and I provide daily updates on Tesla, markets, and technology. Let's get started. Markets are mixed today. Dow Jones is up 0.1%. Nasdaq is flat. S&P 500 flat. Russell 2000 down 0.9%. Oil prices are $63 per barrel, up 1%. Treasury yield is up about 3 to 4 basis points. 10-year Treasury yield is at 4.08. You can see on the S&P 500 heat map that Broadcom is down 2%. Industrials are down generally. Financials are mostly up, and everything else is mixed. Let's read the article of the day. Wall Street subdued as rate cuts bets intact after employment revision figures. Wall Street's main indices were largely subdued on Tuesday after closing near record highs in the previous session, while downwards payrolls revision kept intact bets of interest rate cuts from the Federal Reserve. The U.S. economy likely created 911,000 fewer jobs in the 12 months through March than previously estimated, the government said, suggesting that job growth was already stalling before President Trump's aggressive tariffs on imports. Bets on a 25 base point cut that was already priced in were intact, while ones on a jumbo 50 base point reduction remained at about 10%. Labor market indicators recently have already cast concerns across the minds of investors and Fed officials alike, with non-farm payrolls data for July and August confirming weakening labor market conditions. Israel's attack on Hamas leaders in Qatar's capital city Doha boosted already rising oil prices that lifted the energy sector by about 2%. United Health gained 3% after the health insurer said it expects enrollment in top rated Medicare insurance plans to be in line with its expectations. Inflation reports due this week will also be on investors' radar to gauge the impact of President Trump's tariff policies on the U.S. economy and whether a case could be made for a bigger cut. Given the recent softness in the labor market data, even if we were to see elevated inflation data this week, the Fed would cut rates next week, said Chris Kempsis, managing partner at Barnum Financial Group. Quote, but that would be a one and done rate cut, especially if inflation data remains elevated in the near term. The three main indices finished Monday's session on a higher note, with the tech-heavy Nasdaq closing a record lifted by a rally in chip major Broadcom. Wall Street has had a positive start to September, a month deemed historically bad for U.S. equities, with the benchmark index losing 1.5% on average since 2000. In other stocks, Nabis soared about 35% after the AI infrastructure firm signed a $17.4 billion deal with Microsoft. Rival CoreWeave also rose 7%. US-listed shares of Tech Resources jumped 14% as the miner agreed to merge with London-listed Anglo American on Tuesday. This is interesting. I think companies like CoreWeave and I guess this Nebius stock, I'm going to look into that one, allow companies like Microsoft to basically lease instead of buy the GPUs. So big tech companies are deciding to lease rather than buy the GPUs through companies like CoreWeave and Nebius. Class B shares of Fox Corp and News Corp dipped 6 and 2% respectively. Rupert Murdoch and his children reached an agreement that will give the eldest son, Lachlan Murdoch, control over the media empire. Albemarle plunged 11%, the biggest decliner of the S&P 500, on easing supply concerns after Chinese battery giant CATL expected to resume production at a lithium mine. Interesting. Let's dig into the U.S. employment real quick. U.S. employment falls by 911,000 in government revision, revealing weaker than reported jobs market. The U.S. economy employed 911,000 fewer people than originally reported as of March 2025, providing stark new evidence that the labor market was downshifting long before this summer. The backward-facing data came in well above the expectations of many economists who had estimated that these revisions would be hundreds of thousands of jobs lower. The data covers the period from March 2024 to March 2025 and trims the average monthly job gains seen during this period, roughly the last 10 months of Joe Biden's presidency and the first 2 months of Trump's. from a monthly average of 147,000 to about 71,000. So job gains that we thought the economy added basically halved in that period, March 2024 to March 2025. And that's stall speed. The curious thing, though, is how the unemployment rate has stayed so low. Because this period is basically before any deportations kicked in, any new immigration laws kicked in. So even with that, job growth was only 71,000 a month. It also marks another larger than average downward revision and could provide new fuel for critics of the government's data collection process. Tuesday's release represents a decline of 0.6%, well above the revisions that the Bureau said have averaged 0.2% over the past decade. The report released Tuesday morning showed that the largest downward revisions were in leisure and hospitality, which saw 176,000 fewer jobs than previously thought. The professional and business services industry was second, with a downward division of 158,000 jobs. Leisure and hospitality, which saw 176,000 fewer jobs than previously thought. Interesting. The revisions are almost entirely in the private sector, showing 880,000 fewer jobs there, as well as 31,000 fewer government jobs. Final revised numbers for this period are not set to be released until February 2026. Jobs revisions are a routine practice where the Bureau of Labor Statistics and other government agencies update the estimates of jobs levels as more data, such as quarterly insurance tax filings, becomes available. But jobs revisions have consistently been above average in recent years and have become a political flashpoint, especially since last year's preliminary annual revisions landed in the middle of the presidential campaign and showed the U.S. economy employed 818,000 fewer people than previously thought. The median estimate among economists compiled by Bloomberg as of Monday afternoon was for a decline of around 700,000 jobs. One of the highest estimates was an Oxford economics suggestion that the headline revision number could be 900,000. That's amazing. So even above that, it ultimately was even above that. The political heat has only increased in recent months after Trump reacted to a monthly jobs report by accusing the BLS without evidence of having phony numbers and then firing the agency's commissioner. Trump's pick for a new commissioner, E.J. Antony of Heritage Foundation, is expected to have a confirmation hearing before Senate's labor-focused panel in the coming months. Continue with Fed news. Fed seen on track for 3 rate cuts this year, starting next week. The Federal Reserve will likely resume cutting short-term rates next week and continue on for the rest of the year to shore up a labor market that may have begun cooling well before President Trump began imposing sharply higher tariffs, traders bet on Tuesday. The Labor Department's Bureau of Labor Statistics, we already talked about this, coupled with recent labor market data that shows monthly employment gains have slowed even further, the report gives the Fed another reason to lower rates next week. BMO economist wrote, and likely cements the case for more rate cuts by year-end than the 2 that Fed policymakers had projected back in June. After the data, traders stuck to their overwhelming bets that the Fed will reduce the policy rate from its current 4.25, 4.5 percentage point at the central bank's September 17 meeting. While traders continue to see a 3rd rate cut in December as far more likely than a pause, they pared their bets slightly on that meeting and further for 2026, slicing the probability of a 4th rate cut by January to less than 40% from nearly 50-50 before the revised data was released. That's interesting. I wonder why that is. That's kind of the opposite of what you would expect. Fed Chair Jerome Powell said last month that rising downside risks to the job market may warrant some cautious policy easing, but central bankers remain wary of easing too much while inflation remains above their 2% goal and upside risks from Trump's tariff policy remain. The Fed gets a pair of inflation reports later this week, expect to reflect ongoing upward price pressures. It's actually, I've been kind of thinking about this a little bit more, and I think this month's or the August data can come in either higher or lower. Like previous months, I thought that was going to be higher, and they came in higher, but this one is a little undecided. Guess we'll see tomorrow. Buyers' fatigue threatens U.S. stock rally as fund flows weaken. The recent record run by the U.S. market appears to be in jeopardy as investors retreat from their strong bullish positioning. Flows into U.S. equity funds have been weak compared to the levels seen earlier this year, although they have clawed their way back to positive, according to RBC Capital Markets. Meanwhile, flows from American and European investors into the US and non US domiciled equity funds have been soft, and global flows, excluding the US, have been positive, but with deteriorating trends. When we zoom out, we think this is evidence of buyers' fatigue, head of US equity strategy research at RBC wrote in a note to clients on Monday. She concern centers around elevated equity valuations, a decline in bullish sentiment, and seasonal weakness, with September being historically the worst month of the year. Importantly, within U.S. equity funds, retail flows have faltered recently, Calvasina added. Specifically, passive flows from retail investors into U.S. equity funds is turning negative, reversing prior strength, according to RBC data. A measure of aggregate equity positioning by Deutsche Bank has slipped over the last 3 weeks, but remains modestly above neutral. Positioning by professional portfolio managers is now moderately underweight, down from neutral, and commodity trading advisors, or CTAs, which use systemic strategies to trade derivatives, trimmed their long equity exposure in the US last week, especially in the S&P 500 and the Nasdaq 100 indices. Deutsche Bank strategists, including Parag That, wrote in a note on Monday. US stocks climbed on Monday after Friday's dip of a weaker than expected jobs report. But some trading desks are warning that the Fed's decision on Wednesday could turn into a sell the news event, with investors unloading stocks after the central bank announces its plans. The options market is also signaling concerns about the rally, at least in the near term. The 5-day moving average of total net volume of call options, which give investors the ability to buy the underlying stock, fell last week. The move, which is calculated as call options volume minus put options volume, was largely driven by a drop in contracts for single stocks, which sank to the lowest level in a month, that added. Now, that's one view, and here's an opposite view. Why a Fed rate cut might not help the stock market. I guess, never mind. I misread that earlier. After a weak August jobs report, markets are nearly certain the Fed Reserve will cut rates by 25 basis points at its policy meeting next week, with some investors even betting on a larger reduction. Traders hope a more dovish Fed will boost equities after a choppy summer, but some Wall Street strategists warn that rate cuts may not be all good news for stocks in the near term. Ed Yardeni, president and chief investment strategist of Yardeni Research, warned Monday that easier monetary policy could spark a destabilizing melt-up. Okay, never mind. So this is the opposite view. Ed Yardeni says a rate cut could spark a destabilizing melt-up in U.S. stocks without addressing America's labor supply shortage, strained by President Trump's immigration crackdown and an aging population. We think that by cutting rates this month, the Fed would be stimulating an economy that doesn't need easier monetary policy, he said. Stimulating an economy that doesn't need stimulation won't create more workers to address the undersupply that's constraining the demand for labor. That's a stretch. Yardeni argued that with productivity improving and the unemployment rate still historically low, extra liquidity risks fueling a speculative rally driven by investor FOMO rather than fundamentals. The kind of rally, he warned, that often ends in a sharp correction. Yardeni isn't alone in his skepticism. Others see the risks of rate cuts outweighing the potential benefits. Stuart Kaiser, head of U.S. equity trading strategy at Citi, called August weak payrolls report a negative growth signal, and that is more powerful than the benefit of rate cuts being priced in. Put simply, if hiring continues to slow and unemployment drifts higher, the drag on earnings and economic growth will matter more for equities than the short-term lift from easing monetary policy. Meanwhile, Apollo's Torsten Slok flogged mountain job losses in tariff-hit sectors such as manufacturing, construction, retail, and transportation. Employment growth in these industries has now turned negative, according to Slok's research, underscoring the added strain businesses face from trade policy uncertainty. Inflation could also complicate the outlook if the Fed begins cutting rates in a sticky price environment. Thursday's CPI will show how prices are trading. Bloomberg consensus expects August core CPI, which excludes volatile categories like food and energy, to rise 0.3% month over month and 3.1% year over year, keeping inflation firmly above the Fed's 2% target. Citi noted it would take a major upside surprise to derail next week's anticipated cut, but any signs of a renewed price pressure could limit how aggressively the Fed eases from here. So this is the part I don't really see happening. I don't really see 3.1% year over year inflation on core. I think it might be more like 3.0%. But let's see how that pans out. Let's switch to company specific news, starting with Tesla. Tesla unveils Megapack 3 Mega Block battery storage systems as car business lags. Though small, Tesla's energy storage business is growing. It's another ancillary business that CEO Elon Musk is focusing on per his master plan part 4. As its car sales stall, Tesla is expanding its growing energy storage business. At an event in Nevada Monday night, Tesla announced 2 new products, a Megapack 3 battery pack and a Megablock large-scale energy storage unit. Tesla says the Megapack 3 uses the same inverter and fire protection system as the Megapack 2, but has a more simplified thermal bay for heat dissipation, which includes 78% fewer connections and more power, 5 megawatt hour versus the prior battery's 3.9 megawatt hours. That's not power, that's the energy storage capacity, unless if they're interesting. New cell technology is also in place with supply coming from the US, Southeast Asia, and China. Well, that's interesting. More interesting is the Mega Block, which Tesla calls a medium voltage block that combines 4 megapack batteries along with necessary transformers and switchgear for an all-in-one power storage system. Tesla says the Mega Block is designed for 20 megawatt hours of storage, with a 25-year life and more than 10,000 charging cycles. Tesla claims the product is 23% faster to install than the equivalent setup, with up to 40% lower construction costs. Bullshit. The Mega Block can operate in temperatures from negative 40 Celsius to positive 60 Celsius and has a site level density of 248 megawatt hours AC per acre. Tesla projects it will start building the Megapack 3 at a new factory in the Houston area in late 2026. With an annual manufacturing capacity of 50 gigawatt hours, roughly 10,000 Megapack 3 batteries. Okay. In terms of scale, 1 megawatt hours of energy could power 200 homes for 1 hour. The Mega Block installations connect Mega Blocks into one another to provide a vast amount of storage for small municipalities up to larger cities. For regions that have high peak power usage, like California and Texas, battery storage can be used to offload excess energy when not needed and discharge extra energy during peak times without taking out an electric grid. Battery storage like Tesla's Megablock would also allow energy producers like solar and wind installations to offload excess energy when new energy generation is highest and discharge the energy when generation is low, for instance, at night. Trump White House Energy Secretary Chris Wright recently stated that wind and solar energy infrastructure, quote, is essentially worthless when it's dark outside and the wind is not blowing, end quote. To which Tesla's CEO Elon Musk replied, hello, with a link to Tesla's energy storage systems. Politics aside, Tesla's energy storage business is part of Musk's master plan part 4, which is focused on AI and Optimus robot deployment, as well as clean energy capture and storage with megapacks and megablocks. While the energy storage business grows, the Tesla reporting record gross profit of $846 million in Q2, its bread and butter car business is shrinking. Total deliveries in Q2 were down 13% year over year, with automotive revenues down 16%. And that leads us into the EV market article. US electric car uptake will slow further on Trump policies. Already sluggish adoption of electric vehicles in the US will slow even further after a $7,500 tax credit for EV buyers expires later this month. Battery-powered cars will account for half of US auto sales in 2039, 5 years later than previously predicted, according to a new forecast by EY, a unit of consulting Ernst & Young Global. Growth in EV sales will barely budget this decade, reaching 11% of the US market by 2029 compared to 8.1% last year, according to EY. The forecast is the latest to highlight how policies championed by President Trump are expected to turn the US into a global EV laggard. Trump vowed to terminate what he calls EV mandates as he campaigned to secure a second term in the White House. He directed federal agencies to roll back ambitious emissions and fuel economy regulations, while his $3.4 trillion fiscal package eliminated financial penalties on automakers for not meeting those standards and cancels the $7,500 consumer tax credit for EV purchases on September 30th. EY predicts those actions will make EVs even harder to sell to American car buyers, who already were turned off by high prices and spotty charging infrastructure for battery powered cars. Automakers have curtailed multi-billion-dollar bets on the technology that they made earlier this decade, when they expected battery-powered models to account for as much as half of sales by 2030. Now, car makers are shifting resources back to traditional gasoline-fueled vehicles and slamming the brakes on EV production. GM last week cut production at 2 EV factories, citing slower customer demand. Ford CEO Jim Farley recently told analysts the automaker is reducing EV spending pretty massively, despite revealing plans for a new line on affordable EV models. Easing regulatory policies, high costs, and infrastructure gaps are all working to drive down EV adoption in the US. Konstantin Mgel, global mobility leader for EY, said in an interview. The delay in EV adoption will leave the US years behind China and Europe. EY sees battery electric vehicles surpassing half the market in China in 2023 and topping 70% of sales there by 2039. Let's switch to AI hardware. NVIDIA debuts Rubin CPX GPU for massive AI applications. NVIDIA on Tuesday unveiled its new Rubin CPX GPU at the AI Infra Summit in Santa Clara, California. According to NVIDIA, Rubin CPX is, quote, purpose-built to handle million token coding and generative video applications. Tokens are a unit of data in AI and can represent everything from words to pieces of video and audio. Every time you use a service like ChatGPT, Claude, Gemini, or Grok, they break down your questions and requests into tokens to serve up an answer. The Rubin CPX will work with the company's Vera CPU and Rubin GPU as part of NVIDIA's Vera Rubin NVL144 CPX platform. NVL144 means the system has 144 GPUs. The Vera Rubin platform will mark another leap in the frontier of AI computing, introducing both the next generation Rubin GPU and a new category of processors called CPX, NVIDIA CEO Jensen Huang said in a statement. Just as RTX revolutionized graphics and physical AI, Rubin CPX is the first CUDA GPU purpose-built for massive context AI, where models reason across millions of tokens of knowledge at once. According to NVIDIA, the Vera Rubin NVL144 CPX will offer 7.5 times more AI performance than the company's Grace Blackwell-based BG300 NVL72 system. That, the company says, will also help customers monetize their AI platforms, with NVIDIA estimating they could see $5 billion in token revenue for every $100 million invested. Rubin CPX will be available at the end of 2026. Shares of NVIDIA are up 25% year to date and 63% over the last 12 months. The company reported better than anticipated earnings per share revenue in Q2, but missed slightly on data center segment revenue. NVIDIA's largest customers are cloud service providers, which make up roughly 50% of the company's sales. The chip giant is also working its way through resuming shipments of its H20 GPU to customers in China. President Trump initially banned the sale of processors in April, but reversed course in July. He later announced that the US government would take a 15% cut of chip sales to the region. During a conversation with Yahoo Finance following the company's earnings call, Huang said the production of NVIDIA's next-generation Blackwell chips is ramping at full speed and demands extraordinary. Trump, however, is also considering a 100% tariff on semiconductors, though he said that companies that build in the US will be exempt from the duty. While NVIDIA doesn't build chips on its own, it contracts with companies like TSMC, which is building new plants in the US. And CoreWeave stock rises on news of NVIDIA-backed firm's VC fund for AI investments. CoreWeave shares gained 4% in morning trading after AI cloud computing platform announced plans to support new AI efforts. The NVIDIA-backed company said it was starting CoreWeave Ventures to provide investment resources, technical enterprise expertise, and compute to help AI founders bring new ideas to the market more quickly. The assistance will range from direct capital investment and compete for equity transactions to technical collaboration and go to market opportunities. Co founder and Chief Development Officer Brandon McBee explained CoreWeave Ventures is designed to give other audacious, like minded founders the support they need to drive technical advancements and bring to market the next class of innovation. The company noted that CoreWeave Ventures is already working with a diverse group of innovators, blah, blah, blah. Shares of CoreWeave, which only began publicly trading in March, are up about 150% since then. From one bubble to another. Sailor model struggles as crypto treasury hype turns doubt. The rise and fall with strategies, NAV premium. Yeah, you can see here. I actually shorted this stock around here. Now it's expensive today. It wasn't hard to see it coming. The stocks had soared too fast, the promises had gotten too big, and the math had gotten too weird. These new companies, public firms built to buy crypto and often doing little else, were supposed to offer investors a lucrative way into the digital asset boom. Instead, as their stock prices fall and market confidence slips, the question isn't whether the model is under pressure. Increasingly, it's how and how quietly it could fall apart. Even as risky assets from stocks to corporate bonds push higher ahead of an expected Federal Reserve interest rate cut, shares of digital asset treasury companies are mired in a worsening slide, and their tokens are slumping too. Among the 15 DATs tracked by financial advisory Architect Partners, the average share decline last week was 15%. Wow. Cases are legion. Alt 5 Sigma Corp, which holds the WLFI token issued by Trump linked World Liberty Financial, is down about 50% in just over a week. Healthcare services provider Kinley MD Inc., which holds Bitcoin through subsidiary Nakamoto Holdings, is down around 80% from its May high. Other so called DATs tied to Ether and Solana have also dropped, dragging down the perceived value of the tokens on their books. There are way too many of them and very little differentiation in the US, said Ed Chin, co founder of Parataxis Capital, which recently founded South Korean Bitcoin treasury company. A majority of the well over 100 companies buying cryptocurrencies for the treasuries have launched this year, many of them small firms that recently rebranded overnight: a Japanese nail salon, a cannabis seller, a marketing agency. Jeez. Still, in a sign, the frenzy hasn't fully faded. Some companies are managing to ride a speculative wave. Shares of 8Co Holding jumped over 3,000% on Monday after unveiling a WorldCoin buying plan and naming Wall Street analyst Dan Ives to its board. Yikes. For some, the appeal is clear. A publicly traded wrapper offers access to crypto exposure with potential upside leverage wrapped in a familiar equity format. And in select cases, that model still commands healthy premiums, but the trade is getting crowded. Too many companies have rushed in, offering little beyond the tokens they hold, and as price slide, the confidence that sustained those premiums is beginning to fray. And finally, today we have the iPhone and the Apple event. So let's talk about that a little bit. An iPhone Air, new watches, and heart rate tracking AirPods. What to expect at Apple's September 9 event. Apple will host its annual fall event on September 9 at its Cupertino, California headquarters, where the company is expected to debut its latest iPhone and Apple Watch lineups. The biggest news from the show should be Apple's highly anticipated iPhone 17 Air. Think of it as an iPhone that's been dabbling in Ozempic, like the rest of us. At 5.5 millimeters thin, it will be far slimmer than the standard iPhone and iPhone Pro. The standard iPhone is 7.8 millimeters thick, while the Pro is 8.3 millimeters thick. According to Apple watcher Mark Gurman at Bloomberg, the Apple's thinner design could come with some trade-offs. The phone, for instance, could have just a single wide-angle camera rather than the dual camera setup found on base iPhone or triple camera setup found on Pros. The phone will also reportedly come with a smaller battery, which, unless Apple is able to work some of its software wizardry, could impact battery life. That could make for a hard sell to consumers who generally want phones with more cameras and larger batteries. Case in point, Samsung's own super thin Galaxy S25 Edge wasn't exactly a volume seller when the company launched it earlier this year. Nabila Popal, senior research director at IDC, told Yahoo Finance. Interesting. But the iPhone 17 Air could also serve as a blueprint for Apple's foldable iPhone, which Gorman said Apple will launch in 2026. Samsung followed by a similar formula with the S25 Edge, debuting the thin phone and then revealing the Galaxy Z Fold 7 in July. That phone, which features a design so thin that it barely has room for its USB-C port, is selling very well. Samsung said Fold 7 series have jumped 50% versus its predecessor. Wow. In addition to the iPhone 17 Air, Apple is expected to debut its standard iPhone 17 as well as its iPhone 17 Pro and larger 17 Pro Max. The iPhone 17 Air will replace the older Plus model, which was the weakest seller of the main iPhones. The 17 Air and standard 17 will come with the Apple's new A19 processor, while the Pros will get the company's A19 Pro chips, Gorman reported. According to Apple enthusiasts site Mac Rumors, citing analyst Jeff Poo, these iPhone 17 Pros will get upgraded telephoto lenses along with a redesigned camera bump, making them more distinct from the current iPhone 16 Pros. The 17 will also get a larger display, moving up to 6.3 inches from the iPhone 16 6.1-inch screen. Wall Street analysts are also anticipating a price hike for the latest iPhones, ranging from $50 to $100 for the Air. And on that note, thank you very much, everybody, and thank you to those who said hi on chat. And I will chat with you all tomorrow. Take care.